Good afternoon, everyone. Today we're going to focus on global trade in our current environment. We have two great speakers on hand. Leah Bennett, president of Westwood Wealth Management in Houston. Leah is also a portfolio manager for several of our strategies, including Select Equity. We also have Adrian Helfert, director of multi-asset portfolios. Welcome, everyone. Leah, I'm looking forward to our discussion today. Let's get started.
Thank you so much, Shana. My first question is, and thank you to all the callers who made the time to dial in to listen to this important topic. Adrian, I'm kind of curious, though, the World Trade Organization expects global trade to decline 13% in 2020 due to the pandemic. And it's worth noting that the original projection was for a 32% decline. So a 13% decline is much better than what people expected back in the spring. But I'm curious, what are your thoughts about the long-term implications? And also, what are your thoughts as it relates to portfolio positioning?
Thank you for having me. I'm happy to be here. We were already on a little bit of a downtrend on global trade, and most likely, of course, because we had the trade negotiation tensions that were prevalent in the world at large. So, think pre-COVID, before we had this, merchandise trade volume was going to increase in the coming year by 2 to 2.5%. And we looked for an increase in global trade, even as it was coming off a little bit. Now we haven't seen that, and it has performed a little bit better. When we think about what the implications are, let's start with really what is the important part about global trade. We need that this is essential goods for us. This is global supply chains helping with things like medical products and food products. We need that transparency that's associated with trade and global products. We need technological security in order to facilitate this. That gets down to the implications then. The implications for us are, services exports have been the least essential and the most impacted. So think catering, personal goods, haircuts, things that are consumer spending at the household level. Production hubs that we previously saw in China, United States, and Germany haven't been really impacted so much, but we do start to see the implications that emerging market centers of manufacturing could start to pick up this a little bit further, especially those with good proximity. On the opportunity side, the implications are maybe we start to see more of onshoring candidates, those companies that are local to local trade and transfer, meaning as opposed to having a supplier that is situated in a country for which you can't control the risk or the supply chain with that country, then you find an onshoring candidate, somebody that's located across town or across state or in country, where communication is much easier, security is much easier, facilitation for your planning is much easier. That also leads to there are maybe corporate M&A candidates, mergers and acquisitions for vertical integration, companies that might want to buy pieces of their supply chain rather than have the risk that they can't access it any further. They in-house that now. So we should see more of that. As portfolio positioning, of course, there are some major secular changes we are seeing as a result of this. That technology that facilitates the global supply chain, whereas previously, and in the long history of supply chain management, it's really been much more paper-oriented. It hasn't accelerated as much as other areas of the economy. This has pulled forward much of that, and you want secure communication, secure negotiations. You want security in your contracts with your global supplier. And so the technology that facilitates that, provided by companies, are areas of opportunity that we certainly look at. And of course, there are areas of companies that have revenue lines maybe that are less predicated on the global supply chain, for which reduce the risk that we could be involved in that.
I think it's interesting, anytime you go through these periods of disruption, it does create risk as well as opportunities. And one concern I have longer term is, as we stay in this period, is are we creating some self-dependency as far as countries are concerned? And I think that is a risk. So it is going to be interesting to see how companies adapt once the environment does change, whether or not we have a vaccine, or if we start having some really effective treatments for COVID. But I think the future is going to be interesting. And then the other thing I've been thinking about a lot when we're talking about global trade is looking at areas of the market that haven't run as much. So If you look at the rally, it's been relatively, until August, it's been relatively concentrated. And so obviously the tech stocks have done really well. But if you look at like small cap value as an example, those stocks are still down over 10% for the year, and they're obviously more domestic and might have less risk in this in that area, and the valuations are a little bit more attractive. So I think it's an interesting time to kind of look around and see where there is some opportunities.
Certainly. And one more statement on the back of that, as you mentioned, there is the trade-off between, is this secular or is this not secular? Is this a long-term trend? And, I often look back and say that horrible event of 9/11 is one where the security procedures that went into place that led to you and I spending another 30 minutes or an hour sitting in the airport security queue are still in place. I think you can look at big change, big catalyst events like we have seen with COVID-19 as one that has pulled forward change that historically has just been slower to bleed in. And that is, when we talk about global supply chain, that is technology and communication and facilitation and planning. We've pulled forward these things that will be persistent. And so, looking for opportunities where we can capture the revenue of things that are persistent is what we've been looking at.
Yeah, and I think you bring up a great point, because you could also, some of those, especially on the technology side, could lead to greater corporate efficiency, which could lead to better margins as well. So yeah, I agree. I think it's going to be interesting to kind of see what happens. Another topic on this topic, something else that's come up quite a bit, and this is actually was in the news over the weekend, but is really the sanctions between the U.S. and China on, we've seen quite a bit on U.S. officials and on Chinese and Hong Kong officials, both sides swapping back and forth. And then obviously we saw the U.S. close the Chinese consulate here in Houston a few weeks ago. So I'm kind of curious what your thoughts are. Do you think this could escalate? And again, what are the implications?
I do have a concern it can escalate. The tit for tat that has gone from monetary and trade has gone personal a little bit. And I liken that to, when you're negotiating with somebody and they say, well, I'm going to give you less money for your goods. But then they take it to, unless you sign, I'm going to pull your country club membership. There's a big difference. And, once it becomes personal, which is kind of what they're doing with this, it does concern me a little further. And on a serious note, the implications for that could be that, we see some wholesale things that are retraction or what would be a stop escalation in asserting companies that can't do business in one country or another. And that especially relates now in the United States to some of our large companies, like those that are communications and technology providers, for which the Chinese government hasn't given the tap yet. They haven't explicitly said Apple can't really do business here or has more difficulty in their supply chain in China. That would be a concern if that were to materialize. But that's the minutia. If this does lead down to, as you're asking about the escalation, if this leads to a wholesale escalation in the global trade war, then the big ticket impact really is the depreciation in the Chinese renminbi versus the U.S. dollar, making our export goods, of course, a little more expensive. It impacts our economy. So it's a careful line that we're walking.
Yeah, and I think it is an interesting time to really monitor how much does this escalate and to what point. And certainly another area of risk would be the tech stocks, which have done exceptionally well this year and certainly benefit from this work at home type of environment that we've been in. But they do have a lot of exposure to China, and valuations are quite high at this point. But that's another area that we keep monitoring is what are the tech stocks doing, because I think that's a nice gauge on what's happening between the U.S. and China.
Agreed. Well, certainly. So, within that, I would say that's one of our major concerns on that is looking at that, tech stocks, and especially those top five that are the big ticket. Just, think about Google and Apple and Microsoft that are, such large constituents, and they've risen so well. And part of this is size has been a big benefit to some of these companies because capital costs are lower when capital costs have risen, these companies that can weather a storm have done better. And these companies as well have been centered on the space we're talking about, on technology, on communication, on facilitation of trade. So they've risen so much. In some sense, it's a concern, and it makes it a political bargaining point when we move into trade negotiations.
Thank you. Another great topic that's certainly in the news today is the announcement of Kamala Harris as the vice presidential candidate for Biden. And so I think people are starting to look more and more towards the election. And I'm kind of curious what your thoughts are as it relates to global trade. What are the implications of a Biden win, and what do you think? How do you think things could change if Trump is reelected as well?
Sure. Well, of course, the game did change a little bit, or at least we got more clarity last night from the announcement that she's, was going to be the VP nominee. And let's just, before global trade, let's take it back to the initial focus is, the differential between the two candidates of a President Biden versus a President Trump is the corporate tax rate has been proposed to rise from 21 to 28%. There's a potential for the heightened individual tax rate. This could be offset, though, by an increase in aggregated income for the lower and middle income the sectors, those that might be actually consuming a little further. And then on to global trade, of course, we've seen this escalation over the course of the presidency on global tariffs, and especially U.S.-China trade war and global tariffs. Those two things kind of trade off as far as earnings and market impact as it stands. And we've done some estimations around this and looked at what the market impacts are. It gets down to a point of just about uncertainty and flat. With the outcome of what happens next, I mean, it's too early to call, and we know that just looking at the 2016 election, how fast things switch around on a debate, or things like Rick Perry forgetting an agency on a debate stage, how quickly fortunes change. So it's really too early to call what might happen. As far as the outcomes, we do look at, okay, well, there could be the possibility of a President Trump with then a divided House and Senate. There could be a President Biden with a divided House and Senate, or there could be a Democratic sweep. Of those three outcomes, I tend to think the divided election would be probably one of the best, as that keeps maybe some of the heavier-handed tax implications from happening, while both parties are looking for incentivizing the economy in this time of need with stimulus. And so you hopefully get some of the good with less of the bad.
What do you think if Biden were elected? What do you see happening with the tariffs, as an example?
As an example, Biden has already said that he is still looking at China with I don't know about a heavy-handed eye, but a stronger hand. And so I would anticipate that he probably pulls quite a bit of the tariffs and reevaluates how we're doing trade negotiations, with the possibility of putting them back at some point if they're not actually moving on trade negotiations, if we're seeing breakage on trade one deal or phase one deal, or breakage on phase two. The phasing has been a very good thing for us to introduce, I do believe, of trying to set up granular metrics for progress on how we relate to one another and what tariffs we put on one another's goods. So that's supported by both parties. I think that probably stays in place. I think there is an evaluation or a reevaluation of tariffs as a punitive measure at the outset, and so that gets pulled out. That will be positive for corporate earnings, but it's now a tool in the toolbox more than it ever was. So those could get put back in the future.
It's going to be interesting. Obviously, we'll see very different implications depending on what we see. And you're correct on, it's so hard to predict. Polls, as we've seen, are not very accurate. So we may see a surprise in November one way or the other.
Truly. Yeah.
I think a lot of the topics that we're discussing all lead to the potential of some protectionism, and which can obviously have some long-term consequences. And I'm just kind of curious what your thoughts are around that topic, and where you see some risks.
Sure, and that those two things, you're right, they go hand in hand, or the two big risks right now, the election and the COVID-19 crisis that we've been through, because we've had a global supply chain shock where we've been unable to transact with other countries. And then at the same time, we are becoming more protectionist almost by force, even though beforehand we were going through trade negotiations. The implications of such are we could see increasing cost in the supply chain for individual companies. Those that were previously sourcing either labor or other services or goods cheaper abroad are all of a sudden looking and saying it's more effective to do it domestically, or they want to be more protective domestically, or they're rewarded for doing it domestically. The implications for that are usually negative, and that means a decreasing margin. The costs are higher. You can't shop as you used to for services or goods. So that would be a potential negative impact. That would lead to, if they increase their prices, kept their margins the same, that would push up inflation for companies and for U.S. consumers as well. But rather, there are positive impacts and significant positive impacts on manufacturing of reshoring or onshoring manufacturing. That's in jobs, most certainly. Jobs create consumption. They create a virtuous cycle that I've talked about previously. That also creates skilled labor and a good cycle for skilled labor to continue to create new R&D in the United States. So that's a positive impact. Those two things balance a bit further as well. We are seeing more of the protectionist. It could lead to inflation. That's probably the most prevalent concern. That inflation, it could be that it's more negative for the U.S. consumer, but coming with the influence of increasing jobs, that'll offset. That'll bring some positivity.
Yeah, and a topic, we've talked about this in the past, but a topic that keeps coming up with clients is the concern that stimulus is inflationary, and we keep having discussions that we think it's deflationary as far as not the stimulus, but what's happening as far as COVID is concerned, the demand destruction that we've gone through, and people looking for less, obviously, leasing space as far as companies are concerned, more people long-term working at home. But an area certainly where there is some inflationary risk is in this particular area. I mean, I completely agree. If we become more, if we kind of close our borders as a globally and become more self-dependent, there is the potential for both rising prices as it relates to manufacturing and goods, and then also there's increased risk as it relates to being more dependent on one country.
Yes, most certainly, and that's a good point about being more dependent on one country. Of if you localize your supply chain or in-house or vertically integrate, and it doesn't have to necessarily be that protection means that you are pulling everything domestically. It maybe means you're creating more localized lines, which could be Mexico and Canada as well. But you're more dependent on singular activities or policies or changes that happen in one individual country, or border changes that happen with the Mexican government, for instance, and this especially relates to the auto sector. It will be interesting to see in the next political cycle, be it a President Biden or President Trump, what policies and procedures get put in place, because we're seeing, regardless of blue or red, we're seeing more of that protectionist push, as you mentioned. It'll be interesting to see the kind of supportive policies that go into place that either are in terms of low loan cost or subsidies for companies that are doing business with a more domestic profile. Those are things that will support margins and support cost for them as well.
We're talking a little bit about the beneficiaries of a disruption in the supply chain. Can you drill a little bit more into that? Who do you think benefits?
Well, disruptions in the supply chain, certainly. I mean, one of the biggest things we look at are there, as I say, vertical integration candidates. And when I say vertical integration, that means, large companies like Apple that might look out and say, previously they had a manufacturer of their chips that is non-domestic, or even if domestic, not controllable as far as their cost structure. And so this will create a little bit further push on maybe in-housing some of the supply chain. They call that vertical integration. So you sell something and manufacture something, your input goods, you may be able to start to buy the company and produce at a cheaper cost for your supply chain. And with low rates, borrowing for mergers and acquisitions becomes more attractive. So we look for that to pick up a little bit and think that likely is to happen. As far as other things that could happen there, certainly it is whether we see passage of cost on to consumers and where that might occur, where we could see increasing versus decreasing margins. Companies that are able to pass quickly their cost on through either intermediary supply chain or onto an end consumer may benefit from those that don't have that ability because of competitive pressures in their industry. So there's a lot of little bits to consider around this.
I think those are very good points. Last question, you can't talk about global trade without talking about the US dollar. I'm kind of curious what your thoughts are, both probably near term and longer term, about the dollar. Obviously, it's been strong and we've seen a little bit of weakness the last week or so. What are your thoughts there?
Well, top level, I still look for the US dollar to depreciate versus our major global partners a little further. Granted, that's already happened. We're down around 3% since the start of COVID, so that's back in February, and we are down probably 10% since the peak of around March 23rd when things were looking really bad, and we've retrenched since then. So the U.S. dollar has depreciated with the strength in the market, and the other thing that means is the U.S. dollar is still a safe haven currency. We haven't lost that status, that global reserve currency status. So it does serve as a buffer for those when things go awry. If we were to hit a second, third wave and furloughed unemployment, we're not able to transfer it over to new jobs, the U.S. dollar is still a buffer. But as we are coming out of this, the U.S. dollar is likely to depreciate. As we are going to trade negotiations, we're talking about a bit here, the U.S. dollar could suffer there as well. That's not necessarily a bad thing. That makes our exports cheaper. So economically, that can benefit a lot of companies, not all companies. The other thing that is prevalent is the U.S. dollar valuation relative to partners is valued by relative interest rates. And our U.S. interest rate, of course, we are 0.6% on a U.S. 10-year, which funnily enough is actually quite a bit of room compared to some of our, say, European or Asian partners that are 0 or below 0 on their risk-free interest rates. And their economies are a little bit further as far as expanding or opening up from COVID, which means their interest rates are likely to rise faster to me. As their interest rates rise relative to our interest rates, their currencies will become stronger relative to the US dollar. So I am looking for a cheaper US dollar relative to the major trading partners like the euro and the yen.
Yeah, certainly a benefit for our US multinational companies for sure that are exporting.
Yes, most definitely.
Thank you so much, Adrian. We appreciate you joining us today. As a good summary, I mean, I think we've talked about a lot. Fiscal stimulus certainly benefits equities, and we've seen equities doing very well. There are some concerns that are coming into the horizon in addition to COVID, and global trade certainly is one of those. But anytime we do see disruption, there's lots of opportunities, and I think there's nice ways to position portfolios around some of these trends that we see occurring. So with that, we really appreciate everyone being on the call, and if you have any questions, please feel free to reach out to your Westwood advisor. Thank you so much.
Thank you, Leah.